Okay, everybody, this is Jim with theoptionprofessor.com, and I'm going to be sharing with you my opinions and my observations in the next hour. I've been doing this for decades and have extensive experience in the investment world, so I'm fairly knowledgeable, graduate of Boston College, and I am pretty much aware of all the different markets, so I'll be covering quite a bit here today. Little overview here. By the way, every week I have a weekly update that I get out. And so at the end of the broadcast, if you'd like to get in the queue and receive the free market update, you can do that. I'll explain how. But to give you a little overview on what I've been saying in the weekly update is on the screen, you're going to be looking at the 1, the 2, and the 3-year moving averages. My feeling is that, the minutia is really good. You can do day trade, minute trade, and everything else. But it's also nice to know where the main highway is generally going and try to, generally trade against that highway. So the bottom line is the 1 year, the 2 year, and the 3 year, in my view, my opinion, is a good way of identifying where the highway is going. When they break the highway, it's very important to know what's going on. So let's go through the last 20 years real quick. As you can see in '01, we were way up. And then once these averages crossed over in late 2000, obviously we got a big crash, right? And it took about a couple of years to get back on the bicycle, right? Not too long, but certainly wasn't 1 month, right? Then we go back into the uptrend. Yeah, and this is just following the numbers, right? Following the numbers. And then, of course, we had the big move down in '08. And the averages crossed, and it took a couple of years to get back on the bicycle again, right? Okay, so then we had a couple of different times, one here in '16 and one here in 2018, where the averages were breached, right? Boom, boom. But within a month, you were back above the blue line, which is the 3-year moving average, and you're back on the bicycle, and you're back going on the upside. Everybody who owns any stock longer term is hoping that it's going to be 16 and 18, right? And why would it be? Well, maybe it's because the crisis is going to, and the virus situation is going to pass quicker than people think. Obviously, they were talking about millions of people would perish, and that's not happened. And they thought we might not open till July or August. And of course, we're opening here in May. So there's some merit to saying that the crisis is moving past us a little quicker. Second reason why it could be a short-lived situation is that the consumer loves to spend money. And it seems like we've restocked his wallet with money through unemployment plus $600. So a lot of people are actually making more money than they were making working. Now that's not going to last, but they may not be thinking long term. So the consumer may come back a little faster than you think. And then the third thing is the stimulus, which was absolutely off the chart. I mean, it's like 4 times what they did in '08, and it's only a month into it. So the bottom line is that the stimulus is off the charts, and it was extremely fast. So those are the 3 factors that could get us back going. The other thing that could get us back going is when they start announcing earnings in quarters 3 and 4. It could be a surprise that earnings would have a vigorous return, and people will be in shock because why? Unemployment is going to be huge, and the stock market could be on a rally. How can that be? Well, because when the companies don't call people back, that means they don't have to pay for them. And if they don't take the same real estate down as they used to, they don't have to pay for that. And if you can take the 50% of the largest expenses out of companies, which is employees and real estate, out of the equation, even with less revenues, they can look pretty darn good. So that's one of the reasons that people could be confused if things work out that way, and it could happen. Now, when we were way up at 3,400, I was explaining to people that that is extremely extended off the blue line. Can you see that? So I don't want to really be getting loaded up when it's way away from the moving line, because that's the story called overbought. And there you're going to be subject to possibly getting a good size drop. So again, in 18, we're very far away from the 3-year, boom. And then way down here, we just hit 2,200. Look how far we were from the 3-year, and boom, right back to it. So the bottom line is these moving averages also help me with overbought, oversold. Okay. Now, So we want no part of 3,400 because that's the air is so thin you can't breathe, right? It's very, very high. Plus, there was no GDP to talk about. And of course, they say the unemployment rate was 3.5, but we saw what kind of jobs were going on because they're all lost now, right? 40% of the people or 50% of the people making less than 40 grand have lost their money, lost their job. Those are the people that were feeding into that 3.5% unemployment. And so, you know, you had kind of tough GDP numbers. Your earnings, they had no earnings in 2019. They were flat. And they were talking about the first half of this year are going to stink. And they were hoping that the third and fourth quarter were going to have better earnings to sustain this thing. But of course, once the virus hit and other factors, this thing fell apart like a lawn chair. It folded like a lawn chair. So again, you know, one of the things I was telling people up here is these ETFs are not going to be liquid. Okay. I mean, you can't have bond ETFs and then dealers, you know, coming up with the prices in some basement. In other words, you know, when you go to sell a bond, it goes to a dealer network. Oh, you know, this thing starts falling apart like this. You think dealers are going to throw their real checkbook money in there and step in front of an avalanche? No, especially when they know the Fed's not going to let the world come to an end and they're going to come in with printed money out of thin air. And it's such a joke now, it's even hard to talk about because the Fed balance sheet is on its way to 10 trillion. The annual budget deficit's on its way to 4 trillion, and the national debt's on its way to 25 trillion. So you can forget about fiscal discipline. That's just a big joke. Okay. And actually, paper currency is starting to look a little like a joke. And that's why Bitcoin's getting a bid. And that's why gold's got a bid. So now, so we don't like the market at 3,400, and we're telling people that, and we're talking about hedging. Hedging you can do by a couple of different ways with options. You can sell calls against your stock. You can sell calls against your stock and then take the money and buy puts. That's called a collar. Or since you made so much money at 3,400, don't be a cheapskate. Get off your wallet and just buy some insurance. Gosh, you got insurance on your house. You got insurance on your car, on your life. Why the heck wouldn't you have it on your life savings in the stock market? Particularly when you can use found money. In other words, if you buy puts up here, again, it's a loss and you could offset some of these gains a little bit, right? So the bottom line is you should have been doing some insurance up there at 3,400, okay? And then down here, when the VIX goes to 80, okay, what we were talking to people about is writing puts. Again, Chevron hits 50, you could probably have sold the 35 put for 15, meaning you're going to get it for 20 bucks, or you keep the premium. When Boeing went to 90, you could have sold 65 or 70 puts, took in, you know, 5 or 10 points minimum, and either got the stock at the discount, meaning the strike price minus the premium, or collect the premium. The other thing you can do when you sell puts down when the market's this far down is you can take the premium and buy calls. So if you sell a put underneath the market for 10 bucks and take the 10 bucks and buy a call, well, you're going to be agreeing to buy the market down here. So if it goes down, you got to put up the money and pay for it. But if it takes off like it did, these calls are going to be screaming, and they're actually free calls because you sold the puts down here and took that cash and bought the calls. So there's a few different things you can do either at high points or low points that make an awful lot of sense economically. You just have to know the use and the risk. Now, today I'm going to be going over a lot of information, so I'm not going to be able to go into the minutia of all this, but I am going to be available for questions. Ask the option professor, and I'm going to give you the email address at the end of the broadcast. So if you think what I'm talking about makes any sense, or you think I might have a clue on what's going on, write down the email address and ask the option professor by shooting me an email. Okay, but that's a couple of ideas at the high and low points that I would be talking about. And if you got the weekly update, you would have been aware of, or if you shot me an email, we could have discussed it. Okay. All right. Now, what's happening now? Because I'm going over the general market now. What's going over now is a tug of war. And what is the in what I call the red zone. Anybody know anything about football? When you get into the 20-yard line to the end zone, they call it the red zone, because in that zone, people are either going to score, or they're going to go for a field goal, or they're going to be stopped and get nothing out of it. But it's a zone where scoring should occur. And if it doesn't, that's very, very bad. So why are we in the red zone now? Because we have recovered the 3-year moving average. Let me give you the numbers here. The three-year moving average is 27.91. That's a huge number. You know what that number also is? It's 50% of the decline from 3,400 ballpark down to 2,200 ballpark. Okay, that's the number of 50% throwback. You know, in other crashes, the markets don't generally go back 50% if they're going to go do a retest. In fact, they never gone 50% or better like this and done a retest. So the numbers in history are definitely favoring no retest right now. Okay. Now, if we blow out 2791 and this thing starts falling apart because the virus comes back, then all bets are off. But from what we know now, planning on 2791 being a support zone, planning on the concept that the market is turned is, I think, the way to play it. Now, we need a little bit more proof, and that is getting above the red line there, which is the 1-year moving average. The 1-year moving average is trading at 29.86. It's actually coming down a little bit or flattening out. So you notice we went up there today and we went up there last month, right? So we've gone up there twice and it's been turned away. And it was turned away today because I guess they ran it up yesterday because some test from Moderna that had 8 people in it had everyone breaking champagne out, even though it's, I think, stage 1. I don't think it's coincidental. This company also came out and sold a whole bunch of stock and raised a whole bunch of money during this news thing. So I don't know if there's anything behind it that's fishy, but it smells a little bit to me from the standpoint of what? They had a very small universe of 8 people. They're very early in the trial stage. And all of a sudden, people were acting like this was the vaccine, and people were buying these shares that they issued as if it's hotcakes. And I don't know if that's all coordinated or not. Being paranoid and schizophrenic, that makes me feel it might have been, right? So anyway, that was what happened. And then today they came out and threw cold water on it. They said, hey, maybe it's not the, sliced bread it's supposed to be, right? So the bottom line is people went to the hills. But we're still well within the parameters of 2791 and about, let's call it $3,000, just under $3,000. So there you go. We're in the red zone. If we can get above this last moving average, again, that's going to be the 2988, 2986, okay? Then that would be very, very positive. Could it possibly also come down to the 2-year average, which is 2882? Yeah, and that might be a number to start trading against. And then, of course, the 2791. We penetrated it interday on Friday. We went down to 2766. I just think that was a matter of a bunch of people putting their stop underneath the 2800 number. And, obviously these guys that execute trades, if they see 9 million stops underneath 2,800, they're going to go get them. And if you're stopped out, meaning you are selling underneath 2,800, somebody's got to be a buyer, right? Be nice to know who's on the other side of those trade tickets. You might find out who's on the inside, right? Because all of a sudden, why? It breaks 2,800. All those stops are executed, meaning they were sell stops, right? Because if we break 2,800, people want out of their longs and maybe they want to sell and go short. Okay? So what's the point is that, looks like I got kicked off my screen. I'll come back now. The point is that it went to 2766, but it closed at 2860. So it came back very, very sharply on the end of the day Friday, and that was going to tell you probably that you're going to be looking at a situation where you're going to be getting good action on Monday. Did you get good action on Monday? How does 90 points to the upside sound? That's pretty good action. But again, people today probably thought after a 90-point move, it's going to keep going. Well, they forgot about a couple things. One is turnaround Tuesday. A lot of times the market turns around on Tuesday. Okay, anybody who's been trading a long time knows that. The other thing is that the market did not have great legs this morning coming in. And the other thing is that, again, when the word came out that this miracle cure may not be a miracle cure, that was good enough reason for people to say, hey, listen, I think I'll take some gains. Now, that's what we look like here. Okay, and that's the way I see it. I see it as we're in a very constructive situation as long as we hold 2790. And if we start closing underneath that and these averages roll over, okay, rather than the 1-month pullback like 16 and 18 that I just think we are looking at now, this thing could evolve into an 01 or an 08. And that's why you got to be careful. And that's why you can't go to sleep at the wheel. But there's confusing reasons on why it's going up, but I understand them very well. And again, the reasons they're going up could also go away if, in fact, the restart gets really bumpy, the virus were to come back, or other factors like China, US gets nutty, then of course, again, that could get these people that all bought in here and all the bargain hunters and everybody who did short covering. And if the news goes south and we break 2791, my view, you could be very much looking like '01 or '08, and I'd be prepared for either thing. In other words, I'd be prepared if the thing's going to take off above 3,000, but I would not forget having a little bit of insurance or some idea of an exit strategy should the cards come out the other way. Because right now it's getting to a point where people are only thinking up, and you know, that's the way it looks like it should be betting, right? But again, let the numbers dictate your activities. Follow the tape. Don't fight the tape. Again, you know, it's hard to fight the Fed. They've come in with so much money, and they indiscriminately seem to be throwing it around town, you know. But the point being is that that's a lot of liquidity to throw at the market, and so that's why we're where we are. And that's why we could be breaking through 3,000 and going up to test 3,200 and 3,400, which at this point in time, I would say is the path of least resistance. But don't kid yourself. If the numbers change, I will change my tune. Because if you don't, look what happens in '01 and '08 when you don't change your tune. Okay? All right. Now, two other things that are a little bit concerning as far as the markets are concerned, and I will show them to you. One is on the Russell. These are two things that kept me, you know, neutral to bearish as the market was going up in the beginning of the year. And I will show you one of them is called the Russell Index. It's a small cap. And you'll notice when the chart comes up that it never made a new high during the rally. In fact, you see the higher? That was in September of 2018. So this thing peaked a long time ago. Now, can you see all the lines are crossing over there? So the longer this thing stays down, these lines are going to become more and more pronounced to the downside. So it's very important that we get the Russell back on the bicycle here, and that means we need to get it above 1,500. Then that would confirm that everything's back on the bicycle. Otherwise, what we could be saying is that something that peaked out in 2018, which preceded the high of the stock market by a year or so, could also be telling us that this rally may not be for real. So we need to get this thing going, in my view, back above the 1,500. The other one is the Dow Transport Average. And on the Dow Transports, again, this was another one that told me, don't believe in the rally in January. Don't believe in it. And it was overbought and it had 19 other flashing signals. This one, again, peaked out when? Peaked out in September of 2018. Tried to rally, couldn't take it out. Actually, the financials looked very similar to this. Now, what happened here is what? We've got this thing way down here at 8,200. These averages are up in the 9 and 10,000 area, and they are crossing. So the longer you stay down here, the more pronounced these averages are going to get. So it's important that this transport gets back above 10 grand. Okay, that would make me feel better as far as believing that the rally is going to stick, as opposed to what it could be. I don't think it is, but right now there's no evidence of that. But it could just be, a shot in the arm from the Fed that got everybody excited, and then that shot wears off. Because at the end of the day, you're going to have demand come back. So the consumers are going to have to spend money, and you're going to have their earnings jump. Okay, so I gave you a little overview on how I'm seeing things, and again, a little bit of a view on that. Now I'm going to go over sectors. There's three sectors that are, obviously done very well, and they have more than captured what they lost. And I'll give you a couple of them right now. I'm going to be using ETFs from Vanguard, but there's many different ETFs out there. This one is going to be mega cap. And a lot of it is tech. Well, I'll just put up the tech. Never mind. Let's just put up. Well, I'll show you this one too. Yeah. This thing has just been A real good situation. You can see it barely broke the long-term average, and then got right back above it, and boom, it's way up above the two, all of them. It's all of them. So this one's already gone. In this type of place, you're going to find Microsoft, you're going to find Apple, you're going to find Amazon, Google, etc. Okay, so obviously those are the stocks that are doing well. Now let's take a look at some of them and see if they're extended at all. Let's take a look at Apple, let's say, because Foxconn did announce that their numbers weren't very good, and they're a big, obviously, contributor to Apple. And Apple did have a big run, and so yeah, this would be a place where if you think the market might run into some problem at 3,000, look where the long-term average is, way down there at 200. This baby went all the way up to, it didn't take out the high, came out there, the high was 327. It just came up to a high of 319. And so, if you think this thing might have trouble up here, what could you consider? Well, you might look at those 340 calls, 350 calls, 360 calls. How much are they going for, right? And then you would be a writer of those if you want to do covered call writing. You still own the stock. You're agreeing to sell the stock at 340 or 360, and you're going to capture the premium, right? If you take that premium in and then buy puts at 280, okay, if this market were to have a correction down to either the 1-year moving average, which is, let's see where that is. 1-year moving average is at 258, and the other ones are at 224 and 204. So this thing is extended, no doubt. And so this might not be a bad time to price out and talk to your brokerage firm about what a covered call would look like, as well as what a collar would look like, or even just a married put. But this thing is obviously in an extended point up here. So, this is the time where you start at least pricing out the hedging tactics. Okay, so anyway, that's a sector, tech, mega cap tech, that obviously has had a very big run. It's been a great place to be, but the possibility of stalling out or pulling back is certainly not off the table. Okay, now the other one that has had a big run is the semis, right? So let's take a look at the semis. And the semis, what are they doing? Okay, again, this one has had a big run. It has not even gotten up to the high. It's not quite as overdone. You are looking at the moving averages on the 1, 2, and 3 year at 126, 114, 108, and the thing's trading 136. So clearly, at 150, can you see it's way away from the average, and setting up something to protect yourself against a pullback makes a lot of sense. That's why I like to look at the longer term averages, because it smooths out a lot of the nonsense, and it gives you a little bit of a snapshot on overbought, oversold, and the trend. Anyway, so this is another one that not as extended as Apple, but certainly a little bit extended. NVIDIA is the one people are concerned about as far as valuation and being extended. Let's take a look at it, and that's part of the semiconductor index. NVIDIA. Yeah, I would say it's a little extended up here, but sometimes it just never comes back down. But once this thing stops making new highs, that would be the time to start pricing out some of the call strategies, because this thing is up at 352, and the moving averages are way down here at 200 and change, right? Where are they at? 209, 211. These are way underneath. So what would you be? Now, obviously, this is a freight train right now. I think it just made these prices here today, right? What was the high today? The high today was 363, went home at 352. So it has lost a little bit of altitude. So if this neighborhood in this 2950 to 3000 neighborhood is not going to get penetrated, this would be a candidate to try to do something to protect your equity. Again, that can be done many ways. One would be to write the calls and agree to sell the stock at the strike price for a premium, and just do that, or take the premium you received and get a put in there at 320 just in case it's going to break 340, whatever you want to do, and then basically try to or do a put spread sometimes you might have to sell the call, and these puts are so expensive, so you might have to buy a 340 put and sell a 300 put. At least it gives you some protection down to 300, or 320 down to 260. Gives you a little bit of protection that way, and use the premium up here to pay for it. Again, very difficult to go through any fine print or minutia here with you today. So again, Ask the Option Professor will come up at the end of the broadcast, and you can shoot me an email, and I can try to give you a hand if you have any questions. Okay, so that's one that's obviously very frothy, as the whole sector has had a big move. Some of the other ones in there are not as frothy, I don't believe. Let's look at Qualcomm, and then that has some 5G and other things going on. Let's see. I think it's had a pretty good run. I didn't think it was quite. Yeah. See, it's not as out of control here. 78, and you've got support down here at 65 on there, 66. So that's not as extended, not as overbought. So that's a little bit more reasonable. I think Intel might be a little bit reasonable too here. Let's try to look at Intel. Try to give you a few different ones so you can get a flavor. Some are obviously more extended than others. Intel is trading at 60, and most of its averages are in the 50. So it's $10 away from where the support is, but it's not way up there at 75 or 80, right? Let's look at advanced micro devices. Everybody's into that. And AMD. Yeah, there's another one you got to keep an eye on too, because it's gotten extended, huh? And what did it do today? Well, the 60 number seems to be a rough racket for it so far. And today it went to a high of 56. It closed at 55, so it closed very close to the high. So you monitor it, right? And obviously you can see that a lot of the averagers are way down here at 25 and 40. So like I say, sometimes it doesn't matter. They can go to the moon and just leave you behind. But if you notice, there's other times where everybody thought it was going to go to the moon and it came back down to earth. So let's take a look here at some other historical prices. You can get an idea. I'm sure right here when it went to 06, when it went to 42, and the averages were down here in the 20 area, obviously people probably didn't think it was ever going to pull back either. So, monitor it up here. It's clearly in a higher zone. And if it blows out 60, God bless it. But if it has a hard time with that and you want to try to do something to protect your equity against some type of a pullback, then you bring out your strategies for hedging. Okay, and what else here? Okay, so I gave you ideas on the tech, and again, you can see those have been the drivers. You don't have to be a genius to figure that out. Those have been the drivers. On the last one is healthcare. And on healthcare, you're looking at yeah, healthcare is not as extended, but it's done a good job. You'll see in a second here once I pull it up. And yeah, so it's not that overbought, and it looks like it's got a lot of support underneath it. So the moving averages come in anywhere between 167 and 178. So you got about a 10-point range there of some kind of support with the averages. And again, at 190, while it could have a pullback, it should, if it's going to be any good, remain above that 168 area. And in that area, you've got Abbott Labs, of course, and you've got ABBV, and you've got United Healthcare and Merck and all the rest of them. So let's take a look at Abbott and AbbVie, because those were two that I thought people might have been interested in. They're big on the testing, and so obviously people have plowed in there. But again, let's see if we can move the screen. There we go. Okay, you can see here, that when it just goes to 100 there, obviously that was pretty much a blow off. And when your moving averages are down at 70, you're 50% above the long-term averages. And of course, sometimes that's where you're going to have a pullback. I don't think AbbVie is as extended, and that's what made it interesting. Let's get that up real quick. ABBV. Hold on one second here. Anyway, we'll try to get this up quickly here. Okay, here comes ABBV. And let's see what we got here. Yeah, you see how this is just kind of moving a little bit? So this is interesting to me. Why? Because here's, hey, you got your red line turning up like that. It's crossed over to green and the blue. And so it's trading at 91. And you probably have pretty good support down there at around 79, 80. So, any type of bouncing around, if it can hold the water here, this would be an interesting one because, again, it does pay a good dividend. And it is something that, is not overbought yet. Okay. So we went over tech and we went over semis and we went over healthcare. Those are already, as you can see, on their way. There are some that are just starting to turn. If we are going to get a turn, that I think looks very interesting. So these are just turning. And one is consumer discretionary. And there you're going to have stocks like TJ Maxx and Starbucks and Nikes and McDonald's and Home Depot and Target, et cetera. Okay. But if you notice here, that it has just gotten above its averages, and it's not that far from yeah. And their consumer, if the consumer's going to come back, remember we went over, the beginning was what? The virus may pass faster than we thought. Second part is consumer comes back. Well, this is part of number 2. So what are you looking at here? You're looking at the low point coming in around 167, and the thing is trading at 182. So again, if it bounces back, and it's above all the moving averages. So again, while it did back off today from 185 to 182, if we're not going to break 2790 and this thing comes back into the region here, this would be something I'd put on the radar because it's not already happened like the tech has. With regards to, and again, the companies, I just mentioned some of them. Let's go over another sector, which is starting to look like it's just taking off. And that is in communications. And of course, we got 5G and all the people working at home and all the companies that are going to try to do remote, people working from remote locations. So, here, again, you have a traffic jam of all the averages coming together. 87, thing closed at 89. So again, if this thing can hold water above this 85 number and you start taking out 90, then I think this would be very interesting to keep an eye on because again, communications, which would include, Facebook and Verizon, Disney, Activision, and even some of the infrastructure plays like American Tower and Crown Castle. This could be a very good thing because, again, what we have found out is you can be very, very effective out of a remote location. And therefore, your communication systems are going to have to be up to snuff, as well as your computer system, et cetera. And I just saw that Microsoft is taking their cloud business and combining it with Team, which is their communication business, a la Zoom, and they're selling it to the hospitals, and they're selling it all, or they're not selling it, they're actually giving free trials out so that the hospitals will now use this because they need technology and they need it for teleconferencing and to be more efficient. So, this is where the future is going. And obviously, Microsoft is leading us there. But as the leader, there'll be some people on their tail who also get dragged up with it. And these communication stocks may very well be it. Okay. So that's another one that looks like it might be making a turn. The other one is consumer staples. We're trying to make a little turn. And again, that's what people are saying is that the market may go to new highs even if the tech goes and stabilizes. Because you can see tech may very well go sideways or at least you digest some of these gains, whereas the laggards may get kicked in. And that's what I'm talking about more is the laggards. And you can see some of the laggards are getting above sea level, meaning above the 3-year moving average, and that's a very positive thing. Okay, so this one here is consumer staples. What's in this thing? You're going to have Procter & Gamble, Coke, Walmart, Costco, Philip Morris, Mondelez, those kind of guys. And you can see, again, trying to get above that 3-year, which is 144, closed at 145. So if we can get going here above 150, et cetera, this thing could have a future as well. Okay, it obviously was on a very nice trend for a very long time. Again, it looks like it's trying to recapture that trend. And it's not already extended, which makes it interesting to people that are looking for a little better value maybe. Okay, so those are 3 that have kind of made a turn but are not jumped yet. And now we're going to get the slow pokes here. And the slow pokes would be the IWM, which is your Russell. And if they're going to go back to their 3-year moving average, you can see there's a lot of real estate there because they are way down at, see if I can get this thing to go down. Okay, you can see it's way down at 130 and the moving averages are way up 150. Again, when you get way down here and you hear the Fed showed up, it's a pretty good bet that it's going to have a little bit of a rally, okay? So when you see these averages, what's helpful is you can see how oversold it is. And then when you're looking at doing something, there's one line in the sand at 100. So once 100 was made and the next one was higher than 100, then you got your point to trade against right there. Just like up here, once it hit 170 and failed to ever get above it, that's your point. Okay, so anyway, we were going to look at another one that is lagging, which is your industrials. Another one that's not moving very much. And these are your, although Union Pacific has come back, you got your Honeywell, your Raytheon, your Boeings, your UPS, your Caterpillars. That's who's in this stuff. And let me give you an idea here. Because sometimes it's good to go to a sector and then go look at the stocks that are in the sector and then see how they look like technically. In this short time frame, I can't go into that, but if you get the weekly update, I do look into those very much so. Now this is all jamming in at 140 and we're at 118. So if this thing is going to turn bullish, you got to get above that 140, a 20-point move, which is what? 15% move from here to there if we get moving. Next one is the banks. Oh boy. All right, this is really the contrarian deal here, and I'll explain why. And I'm going to go through some of the names because this could be a very, very exciting deal. Okay, why are the banks under so much water? Because people think they're spread businesses. What does that mean? They need to have a spread between the deposit and the loan rate that's sizable so that they can what? So they can make the spread. Right? And when interest rates are 0, 0, 0, 0, 0, 0, 0, and loan rates are low, 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 there's not much spread out there, ergo they don't think they can make any money. Second thing that is a problem is they think that everyone's going to default on their loans, and they're going to have loan defaults up the gazoo. And the credit card defaults are going to be up the gazoo. So that's the conventional thinking, okay? And that's why we're down in this neighborhood, okay? Now, the question is how could they be wrong? Because obviously everyone's already sold it, right? It's already down. So why could they be wrong? They could be wrong because regulations have been dialed back dramatically, and their window of opportunities on trying to make money are much wider than the spread. So what does that mean? That means that if we were talking 08 and they were all broke and they were coming down like like a ton of bricks on their back to tell them you can't do this, you can't do this, your reserves have to be there, your reserves have to be there, then this would not be a good place to go, at least in the short run. But in this case, they came into this thing very well financed with very good balance sheets. And they certainly have a treasury guy and a Fed guy and a president who obviously does not want to put coaster brakes on these guys. So that opens the door for some surprise earnings later. In other words, they just made a ton of money in the first quarter because when everyone dumped all their stocks, including their own stocks, these guys are market makers and they were doing spreads on all those bonds that were sold, and they did spreads on all the stocks that were sold. So obviously what? They're making tons of money. Anybody who goes on the bond platform and says, what's the bid offer on junk bonds or high yield bonds or even any bond during that collapse we just saw in March? Gosh, the bid-ask spreads were so wide you could drive a truck through them. And they're on the bid while everyone is doing the selling. And then after everyone was sold, the Fed came in, normalized the credit markets, and all those bonds came screaming back that they bought during the collapse. Same thing with the stocks. People are selling out of stocks into a vacuum. Well, they're on the other side of the vacuum saying, here you go, here you go. And there you go. The next thing they snap back and they got huge profits, enormous profits in the first quarter. And that's how they got them, because the bid offers were ridiculous. Okay, so that's what could happen if we could get going here. And there's some pretty good real estate here between 52 and 65, a good 20% up. Some of these even have bigger ones. So let's show you like Bank of America. Now, I'm not saying this is going to happen, but I can tell you, stranger things have happened. And, if these guys are not going to get whacked with bad loan losses and the economy is going to be coming back and people are going to do business, then obviously these people are mispriced. If we're going to see bankruptcies go up to a zillion and these guys are going to have to eat all kinds of expenses, and then there's going to be no loan demand because nobody's spending money, then obviously all bets are off. But here you can take a look at Bank of America, which basically has its moving averages here in the 29 area and is trading at 22. So 7 going into 22 is not a bad bounce back there. The poster child of oversold has been Wells Fargo. In fact, it made new lows not that long ago. Let's see what that looks like. And here on Wells Fargo, you've got moving averages way up here at 50 and 45, and the darn stock is at 23 and change. So you got a low there that was made at 22 bucks, and you certainly would not want that getting taken out. Again, that's what it looks like. So will this thing over time snap back up? Again, if their maneuvers because of their ability, because regulations have been eased on a lot of different things, and their ability to make money is way bigger than just through the spreads, then obviously, there could be a recovery here. But, the numbers will speak for itself. You do have a line in the sand right now at 22, but that line in the sand was only made on, not that long ago, a couple of days ago, in this month. But keep an eye on the banks because, again, they've been thrown out with the bathwater, and they are in relatively good shape. And this Fed seems like they'll print unlimited money for anybody who has a good story. And I'm sure the banks would have a good story if they needed the money. And then, of course, again, if they can get this consumer out there and starting to spend money, even at a 70% clip or 75% clip of what they did, with the lower expenses, I mean, these guys are probably definitely going to become more efficient because you can see that we're not even going into the branches and they're still doing business. So, their methodologies of using technology and remote locations, et cetera, may be something that also in the future saves these guys a ton of money, and that helps their earnings as well. So sometimes darkest before dawn, and it's pretty darn dark at Wells Fargo. Okay, so that's what I was going to show you there on a few sectors. There's actually one other sector that is kind of not sector, but an area of investment that has not recouped yet, and it may be. And these are the dividend paying stocks, which would include who? It would include your J&Js, your Pfizers, your Mercks, your Exxons, your Chevrons, your AT&T, those kind of guys, right? And so basically you're looking at, they're up there at 85 and this thing's trading at 76. So it's got a little bit of real estate to move up. The energy market is another thing that has been thrown out as well. So let's look at that real quick. And let me explain my feelings, my opinions on energy. Okay. On energy, this thing went into the tank big time. And crude prices, went way down. In fact, they went minus 37 bucks. Now it's at about, I think crude is at 37 bucks or 30 bucks. So it's at about a $60 turnaround. So this is wild, right? It's wild. Now, this thing went down to, look, 30 bucks, and where the moving average is 80. I mean, as soon as it makes doesn't make a lower low, you got a point to play against right there. Okay, that's your point. Now, how could it possibly go back up? Well, I'll tell you how. Because we were flooded with oil. Remember how there was not enough boats out there? They were storing it in like the Queen Mary in Long Beach. Only kidding. Anyway, they had nowhere to store it. And so what was the point? The point is that my opinion has been we were going to have an L-shaped supply starting like a month or two ago, and we were going to have a V-shaped demand. And that was going to make oil go from where it was, which was 10 or 15 bucks, up towards 30 to 40 this year, and up towards 40 to 55 next year. And in that environment, these oil companies could actually make a recovery. And that's why many of them have snapped back. Now, I don't know if I'm going to be right. So far, what I'm seeing, I like, because the rig count is way down at like a record low. And the frackers have gone from like 1,100, 1,200 operations down to like 190 or 90, something like that. Low. So you got the frackers going away, you got the rigs going away, and you got OPEC slashing like Zorro with his weapon, right? He's slashing, right? So again, when everybody gets out of their house, rather than jump on planes, you're probably going to drive. In fact, we've already seen, demand for driving and driving hours. People track everything nowadays, right? People drive time has really started to jump again. So again, if that is true, could there be value in the energy sector down here? And I think there could be. So the bottom line is, if you're a believer that the prices will recover towards 30 or 40 by the end of this year, and recover towards 40 to 55 next year, well, you've got a whole litany of different oil companies that could do better than they are now. Now, again, still it's the proof's in the pudding, but the prices have been, shall we say, improving, not deteriorating. So as long as that goes on, then I'm going to stick with my belief system that I've got. Okay, a couple of other things. Bitcoin, right? There's a company, GBTC, and they give you some exposure to the Bitcoin. And basically, it's at $11.41. It's been bouncing around. This is a speculative situation. But, I hear Tudor Jones talk about it, and I hear other people, Tom Lee, talk about it, and they do make some sense. These millennials, they're getting to a point where they don't use cash at all. And then, of course, with the germs going around, nobody else wants to touch cash either, right? And so, Bitcoin, and again, people like to look at stores of value, and they like to identify certain ways that they could say that something is a store of value, and they like to see that it's portable. They like to see that it has a defined amount out there, because they're trying to, and they like to have some length of time that it was in use. That's why gold's popular. 2,500 years it's been around. This thing's only been around 11. Okay. So the bottom line, though, is where's the mood of the whole thing going? Everyone's on their cell phones, and everyone is on the computer using it, and everyone is now going to be using remote working. And now, people are looking at, or everyone's looking at the governments, issuing all this debt and money and paper and paper and paper. And it's going to possibly increase the usage of this, which I think is in the 50 to 70 million users. And of course, if it goes to 100 million users and grows and grows and grows, that obviously would be a positive for the Bitcoin. So again, while it is speculative, it also maybe has a place in people's portfolio, and as a part of it. And again, this sometimes they call it digital gold, and so this thing is above its moving averages here, but it's also all over the place. But it is something if you wanted to look into getting some exposure into the Bitcoin situation, it might be something for you to investigate and take a harder look at. So that's something as well. One other thing I did want to go over here in the last 10 minutes. Well, one thing, let me just go over a couple of stocks that I call the virus stocks, and let's see what they look like. Zoom has got a lot of competition coming down the street, so you got to be careful with Zoom. It's a very good situation. Everyone does like to use it, but when you got Google, Apple, and Microsoft coming after you, it might not be the easiest thing to maintain. But they were, they are the most popular here during this crisis, and so it's right back up again today. And let's take a look at what it looks like, though. Yeah, there you go. Because it hadn't been around that long, it doesn't have a lot of data. The one-year moving average, according to what I see, is 132. So there you have a high point around 180, and let's see how it does there. If it takes it out, boom, there you go. It's got more to go. But keep an eye on it because, again, competition is coming into play. It may be able to withstand the competition, but again, keep an eye on it. But it certainly had a great day today, up 5%. How about Peloton? There are those who believe that this also might have had a pretty big run. Now they've got a subscription business, so obviously that's a very valuable thing in this day and age. If you get a subscription business, people do love it. And so here's another one that was benefiting from the crisis with the virus. And again, it also has not been around very long. It doesn't even have a one-year moving average because it's not been around. And it is, 50 was the high point, and it is trading at 44. So again, monitor it up here and see what goes on. But it's come a long way from when it opened at 20. Again, though, they do have a subscription business, which people love to hear that recurring income. And the last one I was going to look at is Teladoc, which again, Microsoft is trying to help the hospitals get involved with this. I don't know if that'll be a competition to this one either, but we'll have to see. Let's see how it's setting up. Again, so all three of these had a pretty good day today, even though the market rolled over. So that's interesting. And yeah, it's up near the high again, 175. So again, all three of the virus stocks had good days, and they're pressing near their high points. Monitor them and see what they do up here, because again, I think some of these are going to have competition, and they may have a little bit thin air up here if things change a little bit on them. Now, one last thing I did want to go over in the last 7 minutes here, 5 minutes, is some people like to use asset allocation models. I know a lot of the stuff today was short-term trading, and I did try to talk a little bit about short-term trading, but again, it's hard to go over it too much in the short broadcast. Put writing can be a short-term trading. Hedging yourself can be a short-term trading situation. Of course, selling options and then buying spreads with the proceeds is a shorter-term option strategy. All of which, again, ask the option professor. I can go through with you when you shoot me an email. But some people out there want to have some of their money in a fixed portfolio and just leave it and forget about it. And there is a couple of them that I'm looking at that I thought some people might be interested in seeing what it looks like. This one is an 80-20 portfolio. And basically it's 80% bonds, 20% stock. And then you just basically, and they use indexes to do it. So it's a kind of a low cost way of getting a portfolio set up. And as you can see, over the last 20 years, it's been a pretty steady deal. It had the big break in 08, okay? But since 08, it has been a pretty steady deal. And even this time here, it only went from 1650 down to about 15, which is what, 10% drop? So that's not a very big drop. And again, of course, it's right back on the bicycle. So that's an 80-20 portfolio, and it gives you a little bit of an idea of what that has done over the last 20 years. Then you've got the typical, what they call 60-40. And that I'll give you an example of here as well. Okay, and on this one here, your returns would be higher because you have more exposure to stock. But you'll also notice that the bumps in the road have not been tremendously bad. Although this last drop, it got hit pretty good when we went down. But again, after the big drop, again, it's a nice steady ride. And again, you're in indexes. Certain percentage is in a stock index, another one is in a bond index to give you the balanced portfolio of 60-40. And then basically you can see this thing is trying to get back on the bicycle as well. So I'm looking at some of these things. If they can't get back on the bicycle and we were to break 2790, I'm going to change my tune. But at this point in time, again, because we're in the red zone and it's trading above a lot of the averages on these markets, I think, you have to err and not fight the Fed. So basically that's that. But some are extended. Those ones that have been running, the tech, the semis, certainly have really run up. So again, they are a bit extended. And then I showed you a whole bunch of them that are not so extended. There's a lot more to cover. I'll show you one last one is on gold. Okay, and this is GDX. Actually, GDXJ, SIL, SILJ, they're all good to take a look at right now. Now, again, this is the market that just keeps giving. And you'll see that there could be a lot more to come, because can you see here that this thing used to be up at 65 and is only trading at 37. And this thing just looks like it's starting. And if I show you the juniors, they are, in my view, they're also very impressive. These are the junior miners. And this, this is at 40 something, and it used to be 160. So, again, these things, to me, this thing at one point was 160. It's right now at 48. But you can see, this looks like it wants to go someplace. And, again, the averagers are crossing. Could pull back, but the bottom line is there's a lot of white area up here, isn't it? And it looks like that white area might want to get hit. Okay. Hey, guys, I went over a lot of stuff here, and I went over it as best as I could. Again, to get into more fine print, I do have the weekly update that you can get by simply going to optionprofessor@gmail.com. That's OPTION PROFESSOR.com. And I go over the general environment. I go over the stock market. I go over the bond market. I go over the U.S. dollar and the international markets. I go over the crude oil. I go over the gold, and I go over agriculture if there's anything happening. So I give you a full menu of things to look at each and every week. And again, it is free of charge if you just go to the website or the email. Option Professor, OPTION PROFESSOR@gmail.com. Also, ask the Option Professor. You might have questions on something you're doing. You might have questions on something I covered that I couldn't get into any deeper, and you might want to get my opinion and my observation. So I'm more than happy to give you a hand. Ask the Option Professor can be done at the same email. Just shoot your question over to optionprofessor@gmail.com. Okay, we're at the top of the hour, and I'm out of water, so it's time for me to leave. It was great to talk to everybody, and I do look forward to hearing back from you with anything you have for me. And right now, what I'm going to do is turn it over to Anka and let her take it in from here. And thank everybody for listening, and I look forward to hearing from you guys. Thanks.
Thank you so much.